Hello guys, welcome back. So in the previous video we looked into what spread is. We talked about spread and we learned that spread constantly widen and narrow, right, between related assets, right, between related assets. And I said that the assets that we are interested in, they are co-integrated assets, and when we see a widening spread, that is where we are paying close attention to, because there is opportunity there for us. A widened spread for a co-integrated asset is an opportunity. We pay attention to it closely, right? But now the next important question for you becomes, how do best trader, right? How do best traders know when a spread has moved too far away from the normal, right? How do we know that for sure, that spread has moved away far from its normal? Because not every movement is important. Not every movement is important in the chart. Some movements are completely normal, but sometimes the movement becomes statistically unusual, and this is where Z-score becomes extremely important. So by the end of this video, you will understand what Z-score actually means. You will understand how traders measures deviation mathematically, what standard deviation means, and why Z-score is one of the most important concepts in statistical arbitrage trading. So what exactly is Z-score? I'm sure you must have seen on this YouTube channel, you must have seen Z-score on some of my videos on Excel. Yes, you will definitely use it in Excel and you need to calculate it. So what exactly is Z-score, right? What is it used for in statistical arbitrage trading? So it is simple. Z-score measures how far something is from its average. So we have assets that moves, once it moves from its average, moves to a point, and we are expected to either take a decision either to buy or sell. So how far the market, or these two markets, how far has the spread move far away from its average? So let's look at the formula carefully. We see that when we take the current value of the asset, we subtract it from the average, then divide it by the standard deviation. Don't worry if this formula is if it looks technical and you don't understand what the formula is. If you don't understand it, don't worry. So the core idea you need to take away, or what you need to understand, is actually simple. This core is basically asking you this question: how unusual is the current movement compared to the normal behavior? I'll take it again. So what's the purpose of spread? The purpose of Z-score, the reason why we're using Z-score, the reason why we must calculate Z-score, is that Z-score is asking you how unusual is the current movement compared to the normal behavior, right? So to understand Z-score properly, we must first need to understand the idea of an average, right? So you need to understand that in the market, forex market, the crypto market, the commodity market, indices market, relationship constantly fluctuate, right? I'm sure you agree with me. The relationship fluctuates, and sometimes spread moves slightly above average, and sometimes they move slightly below, right? Remember, when I say spread, I mean widening and narrowing, right? So that is normal, right? It is normal for spread to move above average and to move below average. But when spread moves very far away from that, from its normal relationship, that is where traders, best traders, we are paying attention closely, right? So to understand this, I always like to give analogy, a real life analogy, so that you will be able to understand what I mean. Because if I don't use this analogy, you might not be able to understand. So the analogy I'll be giving is this. So imagine a classroom where we have a lot of students, and these students, just look, let's say their teachers are very good, and the student would normally get a certain percentage. Let's say this most of the students will usually score 70%, right? 70% almost every time on the average. But then suddenly one student out of the students who would normally score 70% now scores 98%, right? Or let's say 100%, right? That score stands out immediately, right? And the reason is it is because it is unusually far away, right? It is far away from the normal average, which is 70. And this is exactly how this score works, right? So it measures how unusual current behavior is statistically, right? It measures how unusual current behavior is statistically. Now this brings us to another very important concept, which is standard deviation. And honestly, many traders or beginners, best trader, get scared most of the time when they hear the term standard deviation. But the idea of standard deviation is actually simple. Standard deviation measures how much movement is considered normal around the average. So I hope you understand it. It measures how much movement, how much far away, how much the spread has gone away, has moved away far from its average, around its average, like the normal average, right? Think of it as the market normal for fluctuation range, right? So a low z-score means that the spread is still behaving relatively normal, right? The relationship remain close to average, but a high z-score means that the spread has moved unusually far away from the normal behavior. So another point to note is that we have zero, like if you have to use number to calculate what this score is. So it's from, let's say, 0.1 positive z-score. We have positive z-score, we have negative z-score. So the higher the number, the higher the extremity, right? So plus 3 value for z-score is high, plus 4 is high, minus, that is in the positive side. Then we have negative sides, minus 3, minus 4, they are also very high. So a low z-score means that the spread is still behaving relatively normal. So when we get a value like, let's say, plus 4, right, plus 5 z-score, what does it mean? It means that the spread has moved unusually far away from the normal behavior, and the higher the z-score, or the higher z-score becomes, the more statistically unusual the movement starts looking. So you need to understand that in pairs trading, we apply z-score directly to spread relationship. Most of the time, spread fluctuates normally, right? But sometimes spread suddenly spike aggressively away from its equilibrium, and this is where z-score helps traders, right? It helps traders to quantify how extreme the deviation actually is. This is why z-score is so powerful, right? It is so powerful because now we are no longer relying on emotions to trade, or visual guessing like directional traders. We are using statistics to measure imbalance objectively, right? We are using statistics, the concept in statistics, z-score, standard deviation, spread, correlation, cointegration, and so much of the terms we are using those to measure imbalance objectively, right? So now this is very important. A high z-score does not guarantee reversal, right? A high z-score does not guarantee reversal. This is important that you note, because if you are trading just any pair that you now calculate the z-score, and the z-score is like, let's say 10 plus 10 z-score, now it doesn't guarantee that the z-score is going to reverse to 0, right? Because you can do any in fact any pair, right? Two pairs that you are comparing, you can get z-score value, right? And if you don't use the correct pair, co-integrated pair, right? If you don't use, this is where pair selection is very important, right? So you must make sure that the pair you are trading, or the pairs that you are trading, they are co-integrated, or they are qualified to be to execute trade on them, right? So it doesn't guarantee reversal. A high z-score doesn't guarantee reversal, and honestly, this is where some people get thrown away, right? They don't understand this part where a high z-score doesn't mean that the two assets will reverse to the mean, right? It doesn't mean they will revert to the mean. Like I said, any pair, right? Two pairs that you compare, they will always have z-score, and they could be high, they could be low, but make sure that you are trading co-integrated pairs. So I hope you understand that this strategy is based on probability, right, and not certainty, right? So with trading pairs that are co-integrated, we stack high probability on our favor, right? Trading co-integrated pairs, we have 80, we have 90, even 100% probability that we are going to get a good result from what I mean by a good result, I mean probability that the spread or z-score will revert to the mean, and when they revert to the mean, that is when we are taking our trade off, and that is where we are taking profit. So this is why pairs traders, we think differently. We don't think like the normal traders, right? Most traders focus on prediction but best traders will focus on relationship, will focus on probability, focus on statistics, and a structured analysis. And this is why tools like Excel becomes very, very useful in my trade personally when I'm trading with statistical arbitrage, right? Because all these concepts, they need to be calculated, right? In this strategy, it involves data, it involves calculations, and involves relationship and structured analysis. So if you forget anything from this video, this is a takeaway for you, right? You need to remember this. If you forget everything, don't forget this. This call helps traders to answer one very important question, right? It answers how unusual is the current movement compared to the normal behavior. The current movement compared to the normal behavior. How unusual. Remember the analogy I gave? The student getting a higher grade compared to the standard, the normal average, which is 70%. But now the student is getting a score that is bigger, that is higher than 70%, which is 78%. So how unusual is this current state, 98%, different or compared to the normal behavior, which is 70%? And I hope you understand that. So in the next video, we will talk about mean reversion, and this is where all of the concepts that we have been discussing they are coming together, right? Spread, deviation, equilibrium, and z-score. This is where they are now connecting together, right? The mean reversion is where everything becomes they are connecting beautifully together, right? So I'll be talking to you in the next class. Until then, bye.